Many companies use their weighted average cost of capital for their discount rate. So we're going to calculate the weighted average cost of capital for Micro Advantage. We have a lot of information here about the number of bonds that they have outstanding, their current market value, their tax bracket, the number of preferred stock outstanding, its current market value, and the number of shares of common stock outstanding and their current market value. So when we calculate our weighted capital, we look at what our debt to equity balance is in the company. So we're going to start with our bonds. And what is our bond interest expense before taxes? So we have $5 million in bonds and a 30, or where's our interest? 9% coupon rate. So our bond interest before tax is $450,000. Our income tax savings from bond interest, we take our bond expense times our 30% tax rate. So after tax, 450,000 minus 135,000. Our market value of bonds is 500,000 times their current market value of 110%. So the current after-tax cost percent of this debt is our after-tax interest expense divided by the market value of our bonds as a percent. And now we're going to look at the after-tax cost of preferred stock. So we have our dividend per share. So our dividend per share on preferred stock is $3. And our current market price per share. So our current market price on preferred stock is $30. So our after-tax cost, or percentage that we're looking for, is 3 divided by $30. 10%. Okay. Now we're going to look at our weighted average cost of capital. So we start with our current book value of our assets. So the book value on our bonds is $5 million. The book value on our preferred stock is $5 million. And the book value of our common stock is our 50,000 shares outstanding times the par value of $10 per share. We then have our interest or dividend rate. So the interest rate on our bonds is 9%. And our interest rate on preferred dividends is 10%. We don't have an interest rate on our common stock. Our after-tax rate or expected return we calculated for bonds is 5.73%. And for preferred stock is 10%. Now this problem tells us in the information that our expected market rate of return on common stock is 20%. 20%. Okay. Then we need the current market values of our bonds, preferred stock, and common stock. The current market value of our bonds we calculated is $5.5 million. The current market value of our preferred stock is the current market price. So our current market price, $30, times the number of outstanding shares. So we're going to take the beginning par value or the par value of our preferred stock, divided by our par value per share. So we have a $6 million current market value. And the current market value of our common stock is our 50,000 outstanding shares times the current market price. And if you didn't have that information for a company, you could look it up on the internet by searching what their current stock price was and looking through their financial statements for the other information. Then we add up the totals of our current market value to determine the weight of each item. So we take our bonds divided by the total amount, and then preferred stock divided by the total, and common stock divided by the total. We then take our after-tax rate of expected return times the weight of our debt to equity balance. So we take the 5.73% times the 0.275, and so forth. We add those components together, and that gives us our weighted average cost of capital. Companies would use this weighted average cost of capital as their discount rate when they're making capital budgeting decisions. Next, we're going to look at calculating the net present value and the internal rate of return on an asset topic. So we're looking at considering that we're purchasing a new distributed network computer system. The system costs $60,000 to purchase and install and $30,000 to operate each year. So our outflows in year 0 are $60,000. Well, we're going to put a negative in front of that, because for the internal rate of return and the net present value, it helps us if that's just already a negative number. So that is our first year cash. Okay. To determine our other year's cash, we have very different situations. So in our first situation, what is the net present value if the firm is not yet profitable and pays no taxes? So we don't have any taxes. We don't need to worry about the tax shield on our depreciation. So we just need to look at what are those cash flows. So we see here that we expect to save $62,000 a year. So that's a positive. And it's going to cost us $30,000 a year to operate it. So that's our outflow. So our net cash flows for the year are the positive cost reduction minus the operating costs, or $32,000. So to calculate the net present value, we would say net present value, and then we select the rate. Our cost of capital is 10%. Select only the 1 through 4 values, and then add the year 0 value. And we get a net present value of $41,435. Situation 2 says, what is the net present value if the firm is in the 30% income tax bracket and uses straight line depreciation with no salvage value? So what is the net cash flow before depreciation expense? We already calculated that. It's $32,000. Our straight line depreciation, you can use that in Excel. We have our historic cost, salvage, and useful life. So our increase in net income before tax is cash flows minus depreciation expense. We take our increase in net income times our 30% tax. And that gives us our tax expense of $5,100. So we have our cash flows. We have our negative cash flow of $60,000. And then now our cash flows are $32,000 minus that $5,100 income tax expense, or $26,900. And that's for every year. Then we'll calculate the net present value. So equals net present value, our rate of 10%, the positive cash flows in year 1 through 4, and then we add the year 0 cash outflow. So the net present value, if we are in a 30% tax bracket and have straight line depreciation, is $25,269. Okay. Next we have, what if the net present value, if the firm is in the 30% income tax bracket and we use the double declining with no salvage value. So we have the double declining table. We start in year 0 with 60,000. So our depreciation expense is the book value times our double declining depreciation rate of 50%. Okay. So in year 2, our book value is 30,000 and our depreciation expense is 30,000 times 50%. Now our accumulated depreciation is 30,000 plus 15,000, and our new book value is original cost minus so our 3rd year depreciation expense is 15,000 times 50,000. Accumulated depreciation and our ending book value. And our last year, our depreciation will be $7,500, and our accumulated depreciation is now $60,000, and we have an ending book value of 0. So we have pre-tax cash flows in each year of $32,000. Then we have our yearly depreciation expense from our table up here. And if we take our inflow minus the depreciation expense, we get our taxable income each year. Then we take our taxable income times our 30% rate. To get our income tax for the year. And we have our pre-tax minus our tax expense, and that gives us our after-tax net cash inflows. So what is the net present value in this situation? Well, we have equals net present value. Our rate is 10% from up here. Our cash flows for years 1 through 4. And then we need to add the year 0 amount. The next question that we look at is, what are the estimated internal rate of return for each example above? So let's put in the 0 rate here, because that will help us. Okay. So not yet profitable and no taxes, IRR. And then we just select all of the values. So year 0 through year 4. That tells us the internal rate of return on that project is 39.08%. So internal rate of return for the straight line depreciation scenario and the internal rate of return using double declining depreciation. All of these are above 10%. They have a positive net present value, so we already knew they were above our discount rate of 10%. And then we can decide which method of depreciation we need to use for those. Okay. So the last example that we're going to look at is this asset replacement. So we have this asset that needs to be replaced. Bring the entire amount so we can read this. So we have a new machine and we have information about it. So we have machine A, but we were also looking at the possibility of machine B. So if we purchase machine B, we would generate annual savings of $280,000 for a 3-year useful life, or we continue using machine A. So we're going to look at these different examples. First, we want to know what is the relevant cash flows after tax for each of the following 3 points related to the asset replacement. So the project initiation, project operation, and the project disposal. So we have the net present value of asset A, which is currently $300,000, or the net book value. Its current disposal value is 0. We expect a gain or loss on disposal, so if we get rid of it now at its current book value and buy machine A, we would be losing $300,000. We would have a negative or a loss on disposal. That would give us a tax buffer. So our loss times our 40% rate gives us a tax savings of $120,000. Next, we're going to look at the gross cost of asset B. So we need to pay $600,000 to purchase asset B. We have the tax sale, the tax effect of disposing of asset A in this $120,000 savings. So our outlay on replacing A with machine B would be $480,000. At the end of the project, looking at our project operation, our annual depreciation deduction for A is $100,000. So we have $30,000 divided by, or $300,000 divided by a 3-year useful life. And for B, we have a $600,000 asset divided by 3 years for straight line depreciation. So our annual tax benefit or tax shield with machine A would be $100,000 times 40%. And for B is $200,000 times 40%. So the differential tax savings, assuming we replace our asset, we replace A with machine B, we're going to save $40,000 a year in taxes because B's depreciation is much higher than A's. So that's going to give us an extra saving on depreciation. Next, we're going to look at the annual pre-tax savings under asset B. So our pre-tax cost savings with machine B, 280,000. And our tax on those cost savings is $112,000. So our annual after-tax cost savings is $168,000. So our annual after-tax inflow with this machine replacement is $208,000. The net present value of that replacement, so we have the negative 600,000 or negative 480,000 after the tax shield from the loss. And then our inflows of 208,000. And now we have the net present value. Our rate is 10%. Our cash flows for years 1 through 3. And then plus our year 0 outflow. So we have $37,265.21. So do the net present calculation here so we can run goal seek. So our rate is 10%. We have the values of year 1 through 3. And then add our outflow. Okay. So now we want to know what is the break-even weighted average cost of capital. So what weighted average cost of capital makes the net present value 0? We go to data, let's click our what if analysis and choose goal seek. So we want our net present value to be 0 by changing the weighted average cost of capital. So at a weighted average cost of capital of 14%, the net present value of this decision would be 0, at which point it wouldn't matter if we replaced machine B or A because the net present value would net out.